that is Introduction to Insurance, lecture session part 2. In our previous discussion, we have already seen the meaning of the insurance, characteristics of the insurance, and is important parties to the insurance, terms of insurance, etc. Now, the next discussion point that we need to understand in this part of the lecture series is the requirement of an insurable risk, adverse selection and insurance, insurance versus gambling, insurance versus hedging, and types of insurance. Let us go to the first important point that we need to discuss is insurable risk. What is insurable risk? A risk that conforms to norms and specifications of the insurance policy in such a way that the creation for the insurance is fulfilled is called an insurable risk. It means that all the risks are not covered under an insurance contract. There are specific risks which are notified and acceptable are covered under insurance contract. Insurance companies cannot compensate any type of a risk that business people incur. Policy cannot be taken on all types of insurance in all types of risks. Insurable risks are specific in nature. What kind of risks are covered under the insurance contract? If you consider a risk which satisfies a specifically 6 important points are considered to be insurable risk, and only insurable risks are covered under the insurance contract. What are those important conditions that are to be satisfied to make a risk as an insurable risk? First one is an insurance company can compensate only that risk which must be large in risk. The risk exposure should be for a large number of units. If it is one single person specific kind of a risk, insurance companies do not come forward and compensate. Because the basic fund of the risk insurance contract itself is accumulation of a premium from many people. That is large number of units which are exposed to a specific risk where the premium is collected. And it is anticipated that all the exposed units do not incur the risk at the same time. For example, if 100 houses are insured for a fire, all the 100 houses will not get a fire at a time. Only one or two or probable calculations are made by the insurance companies. Only that much will be burnt out in a specific given period of time. And those units are compensated. The risks of burnt houses are compensated. The loss is compensated out of the contributions made by all that 100 units. So risk is covered by pooling the risk on the several people. So therefore, insurance companies will take only those risks which are common for specific number of units. If there is a large group of units which are exposed to a similar kind of risks and possibility of happening a risk is minimum, in such cases, insurance contract is developed by insurance companies. Otherwise, if 100% of the units of the houses are getting burnt and possibility of exposure damage is more, then insurance companies will be under a loss. The insurance companies will only work on the probability of the loss, where the loss is always less than the amount of the premium that insurance company collects. So therefore, the first condition to be satisfied to make an insurable risk is the exposure of the risk by the number of units is, if it is more, then insurance contract can be undertaken. Otherwise, it cannot be. The second important point is the loss must be accidental and unintentional. Suppose if any loss that is going to happen out of the agreed risk in the insurance contract, the loss must have happened by accidental or unintentional. For example, if a car is insured against an accident risk, and accident should have happened even if the driver makes an attempt to control it. Even there should not be any intentional collusion made by the driver. If the driver intentionally hits it, it is considered to be a suicide by the driver under an accident situation. This kind of losses are not covered. The loss must have happened, and the loss must have happened because of accidental type, but not intentionally done. And the loss has happened out of the specified risk. Like if you take an insurance policy on a car against an accident, the loss should have happened by accident only, but not by any other situations. If the car gets damaged, insurance is not paid. So therefore, the second important point is any risk to be covered. The risk, the loss of the loss out of that particular risk should have happened because of accidental nature, not an intentional. Third one is the loss must be determinable and measurable. That is why it is said only the financial losses are covered under the insurance contract. If it is non-financial losses will not be covered under the insurance contract. This is not a risk to be covered under the insurance contract. What is that measurable loss? If an accident happens, any property is damaged and the property valuation can be made in terms of money, that is quantifiable. Only that kind of quantifiable losses are covered under the insurance contract. If, for example, a psychological damage to a human being or emotional disturbances to the person losing the particular property is not calculated under the financial way, so such kind of risks cannot be covered under the insurance contract. So important point to be noted here is only the risk which is determinable and measurable are covered under the insurance contract. That is called as insurable risk. Then fourth important point is the loss should not be catastrophic. Catastrophic means should not be a kind of common to all. Catastrophic in the sense a kind of disaster happens where 100% of the insured units get spoiled. In such cases, insurable risk does not arise. An example is the loss should not have incurred to the whole of the exposed units. Otherwise, insurance will not work properly. Such kind of losses will not be compensated. Simple, for example, if 100 ships are taken as a members of the insurance contract, and insurance company receives the money from all these 100 units under the condition that 20% of the loss happens when the peril of the sea happens, and only 20% of the ships may sink in the water. Suppose if all the 100% or all the 100 units of the ships sink in the water, then this kind of a risk is not insured in the insurance contract. It means that the loss should have happened to the minimum percentage of the insured unit. Insured unit. That is the condition to be satisfied. Next one is the chance of loss must be calculable. It's, for example, the chance of loss refers to in future. How much is the loss going to incur by the risk happening? Simple example, if you are taking an insurance policy on particularly a car accident, then the insurable calculation of the loss should have been made in advance. For example, what is the maximum amount of the insurance money that you can pay if the loss happens? For example, in case of car accidents, loss may happen either because of the collision to the other car, or because after the collision, if the death of the driver happens. So these are all the various losses. Suppose if the losses are to be covered and calculated, future loss calculation should have happened. Say for example, if the car value is 5 lakhs rupees, 100% of the car gets damaged, insurance company will pay 5 lakhs rupees. This amount of 5 lakhs rupees is calculated in advance. After happening the risk, the calculation of the loss should not be, because there should be a maximum limit of insurance amount to be calculated and decided in advance before undertaking a contract of insurance. This is called uh, the uh, the calculable point of the risk. The next last one is the premium must be economically feasible. Suppose an insurance contract is undertaken and the premium of which is very huge and economically not feasible for the person to pay. In such cases, it is not an insurable risk. For example, a very precious diamond, like for example, the Shalimar diamond, if it is lost, the rate of which is not mentioned now only. In such cases, insurance contract cannot be taken into account, because if you consider the price of the uh, diamond, Shalimar diamond is in Arabs, and the premium of that cannot be paid by any king who owning it, or any person who is owning it, then there is no point of insurance contract at all, because economical feasibility is not there with the person to pay for the price of that particular thing. Economic feasibility talks about the existence of an asset should have led the profit to the person who is owning it, and the profitability what he receives should be a partial amount of paying the insurance premium. The insurance premium what you pay should be always less than the benefit what you arrive out of that particular asset. That is what possibility of a premium payment. If the premium payment is uneconomical and not feasible, the amount of the premium cannot be calculated. In such cases, insurable risk cannot arise only. So if a risk is satisfying all these kinds of six conditions at a time, then only it becomes a insurable risk, and insurable contract can be created. I repeat once again. Here, if the risk is uh, is exposed by the units, a large group of people are units are covered under the risk, insurable risk arises, and it is quite uh, profitable. It is a quite feasible kind of insurance contract for the insurance companies, and the loss which is happened by the exposure to the risk should be accidental, and the loss what is supposed to happen in future should be calculable. That is what we call as measurable. The loss should not be catastrophic, that 100% of the unit should not be get lost. In such cases, insurance contract risk cannot arise only. Payment of the compensation does not arise only. And the chance of the loss must be calculable. The premium must be economically feasible. The next important point that we need to discuss under the insurance understanding is adverse selection and insurance. It is a very complex kind of analysis. Let us pay attention to understand this concept, adverse selection and insurance. Before understanding adverse selection, let us understand a concept called asymmetric information. You know that symmetrical information, asymmetrical and symmetrical, they are opposite words. Symmetrical means on both the sides there is a similar kind of a thing happening. Asymmetric in the sense it is not happening in the same way. In an insurance, in any kind of contract, a risk taking will happen only when there is a symmetrical kind of a thing happening. Asymmetric is leading to certain kinds of danger things. What is asymmetric? Where one party knows the information better than the other party, than the other party, and the party who is having a more knowledge can hide those things and may deceive the other party to influence the contract. An example is, a seller knows better information about the product and buyer knows less about the product. So seller explains about the product and convinces the buyer to buy the product only when buyer gets convinced with all that information. When both the parties come under the similar kind of a thing, sale contract will happen. Otherwise, if the seller knows that product is having a defect and does not disclose it to a buyer, and buyer buys it, and it is cheating happens. Normally, it happens. So this kind of risks are there in most of the types of insurance contracts. How this asymmetric information happens? Suppose if insurance company is ensuring the health of the insured person, an individual's health insurance is being taken, the disclosure of the health related information by the insured person should happen at the time of entering into a contract. An individual should explain full about his body nature. Suppose if he is a smoker, he should tell that he is a smoker. If he is having any uh, uh, diseases already with him, he should disclose those diseases. Suppose if he is a diabetic, he should tell that he is having a diabetes. If he is having a heart attack already, blood pressure, he should expose that. This is what we call as utmost good faith. If he exposes all that information, insurance company will be able to understand this kind of things and decide the premium which is feasible for the insurance contract to enter, where both the parties will have a symmetric kind of a benefits. Suppose in most of the cases what happens, the insured person who knows more about his health does not declare any information, and there are most of the chances that the insurance company will take such kind of insurance contract at a standard premium. A standard premium is one where a normal condition of the health problems are covered. But if at all the insured person is having any abnormal condition of the health levels, and there will, if it is selected and contract is made, insurance company will undergo a problem. This is what we call as adverse selection of insurance contract. Adverse selection. It is a danger point of a thing. And what is adverse selection is, if you select the people whose risk cannot covered under a standard insurance premium level. So, and if you select them, that is called adverse possibility of the selection. Another simple example that you can understand easily: if you go to any hotel, there is a price fixed for an unlimited meal. Say, for example, 200 rupees for an unlimited meal. In this case, it is 200 rupees is decided under the condition that most of the people who come for the hotel to eat cannot consume any food more than rupees 200, because the cost of production of food is less than 200. Anybody who goes there and takes up the chance will be having. But there are certain abnormal people who may eat more than 500 rupees amount of food, and if lot of people are of such nature, then the hotel will be definitely undergoing a adverse selection problem. So this is quite common in insurance contracts. So in this case of insurance, adverse selection is a tendency of those in dangerous jobs or high risk lifestyles to purchase products like life insurance. In these cases, it is the buyer who actually has a more knowledge, that is about their health, to uh, fight adverse selection. So this is what adverse selection condition, where the insured may hide certain information which is necessary to be given, and takes the policy at a standard price, and afterwards the insurance company has to suffer because of the abnormal condition of the risk, abnormal condition of the health risk of the individual. So in this case, insurance company has to avoid this with following certain strategies. That is how it can avoid this. To fight adverse selection, insurance companies reduce exposure to large claims by limiting coverage or raising premiums. Either they will reduce the coverage of such high risk population, or they will raise the premiums for such kind of a thing. Or most insurance companies face the challenges of adverse selection and follow insurance guidelines and the legal procedures to tack tackle the issue. Therefore, they follow the principles of insurance, that utmost good faith and related informations and conditions where insurance contract is cancelled and all that. Everything is mentioned in the policy, and the policy document is explained to the insured and insurer. So, like this, adverse selection problems are reduced. So, this is regarding adverse selection and insurance. Next, we need to understand the difference between insurance versus gambling. Insurance is not a gambling, and in gambling is resembling like an insurance, but it is not an insurance at all. And we need to discuss even insurance versus hedging. Let us understand the difference between insurance and gambling. What is gambling? Gambling is betting kind of a thing, a lottery business, or playing a cards, rummy games, or betting on the horse. They are called as gambling, where two parties, one party says that a horse will not win in the race, the other party says that the horse will win in the race, and both the parties will challenge and put a money on that particular thing. If the horse wins, the person who has bet that horse will win will receive all the money, and vice versa happens. So this kind of agreements are called as wagering agreements. This kind of contracts are called as wagering agreements. So now if you understand the difference between the two, whether insurance business is like a gambling, because in insurance contract you will understand the gambling kind of a characters. You will come to know some points like a gambling. Suppose, for example, insurance company will promise to compensate the loss to the insured under health insurance contract, that if a person suffers from any diseases, critical illness diseases, the expenditure of the medicines will be covered by the insurance company. If he suffers, he will definitely get the benefit from the insurance company. If he does not suffer, then the insurance company will collect the premium but will not pay any benefit to the health insured. So this is what the situation of gambling. So it resembles that insurance company is gambling with the health risk of an individual. Similar with the accidental policies in motor vehicles, fire insurance policies in home general insurance contracts and all that. You will come to know most of the insurance contract resembles gambling, but gambling is different and insurance contract is different. On what grounds we can differentiate between insurance and gambling? There are four important basic grounds on which we can identify the differences between the insurance company and gambling. Insurance is not a gambling business. How we can prove this? The first one is enforceability. Insurance, a contract of insurance is illegal and enforceable by law, whereas wager contract has no legality or enforceability. Insurance contract is a legal contract where if the party who is insured against the health problems and suffered from the health problem and asked for the compensation if the insurance company does not pay insurance, in such cases, the insured can go to a court and influence on the agreement. In such cases, insurance company has to compensate the loss happened to the insured out of the health hazards. But in case of a gambling, that is wagering contract, it is not legally enforceable. Suppose if two people bet on the cricket match between India and Pakistan, one person say that Pakistan will lose, the other person say Pakistan will win. And suppose if Pakistan wins and the person who bet on the losing does not pay the money, and if the person goes to the court who has bet on the winning of that particular thing, court will disqualify it in the initial stage itself because it is a contract ab initio. But there are certain contracts, wagering contracts, which are approved like a lottery business and these things, where it resembles like an insurance contract. The horse race in a particular horse lane, which is permitted by the law, is a valid contract. But the lottery business, if it is supported by the license of the organization, government, is also what you call as legal business. But it differs in another point, that is utmost good faith. The second important point is in every insurance contract, duty of the utmost good faith is to be covered. Utmost good faith in the sense the facts relating to the uh, contract should be clarified by both the parties. Suppose, for example, a person who takes a health insurance called insured has to declare full amount of full information relating to his health to the insured company. Insurance company should also declare at what point of time he is going to compensate the losses. So there is a agreement. But in a wagering contract, no such duty is observed in a wagering contract. No such utmost good faith point is available. Say, for example, if you are betting on the horse, nobody will study the health of the horse. Nobody will study the person who is telling about the health of the horse. Even they don't know the addresses of each other. They don't know personal identification of each other, but they bet on the information. So there is no declaration of such. If you are buying a lottery of any of the company, you are not understanding what kind of a lottery it is, how many people are buying the lotteries, and what is a common pool and all that. Nothing is informed to the person. So it's not a what I call it, utmost good faith is not followed. Then the second important point is protection. Insurance contract provides protection for the loss. Wagering contract does not provide any protection for the loss. Loss happening or loss gaining has no any meaning except for the purpose of transaction. The last point is insurable interest. Insurable interest must exist in every insurance contract. What is insurable interest? If insured is taking an insurance on any of the property, there is a condition that the existence of the property must have fetched a benefit to him, and the loss of the and the destruction of that particular asset should have should have led to a loss to the person. Then only he can take an insurance policy. Suppose if I have a house, if the house is lost, I will be under trouble. And if the house is in existence, I will get the shelter and rent on the house. So I can take insurance on my home. But if suppose I am staying in a rented house, and if the loss happens to a rented house, actually loss does not happen to me, it happens to the owner of the house. In such cases, I cannot take insurance policy on a rented house. This is what we call as insurable interest. Such kind of insurable interest does not present in a gambling contract. No insurable interest exists in a wagering contract except the benefit that they get out of the results. That is what the difference between the two. The next one is insurance versus hedging contract. There is a one more term called hedging. What is hedging? It is stopping the loss happening. It is a stopping loss. In Kannada, it is called as Beli hakodu. Beli means stopping out certain kind of entry in our premises and destroying our premises. That is what hedging actually means. But this hedging contract is used in most of the stock exchange operations and in commodity markets. What is hedging? Let us understand it properly, because we have already understood the contract insurance. Insurance is a agreement between the two parties, insured and the insurer, where the insurer promises to compensate the loss to the insured when the loss happens against a premium amount. Hedging is also similar to insurance. Hedging is also similar to insurance. What is an hedging? Just I will tell you. Suppose if the farmer is growing up onion and the onion price in the present market is rupees 100, uh, he is under the trouble that if at the time when he gets the onion in the market price may vary. Suppose if 100 rupees is the market price, it may fall down to rupees 50, it may fall down to rupees 20. In such cases, he will make a future contract with the buyers on the present price. This is called hedging, where the problem happening to the farmer due to fluctuation in the market can be avoided by this kind of a contract. This kind of a contract where the market price coverage is hedged with the buyers, where the future contract, even if the market price falls down also, buyers have to pay the same amount for the purchase, and even if the market price is increased also, the buyer seller is going to sell at the same price to the buyers. This is called hedging contract. Whereas insurance is different, hedging is different. By comparing these examples, a health insurance and the market price hedging of the farmer, we can understand the difference between the two in the five important parameters. One is insurance cover pure risk, which whereas hedging is for uninsurable risk coverages such as market price fluctuations. What is a pure risk? We have already discussed while discussing the different types of the risk, financial risk, pure risk, and all that. What is a pure risk? Pure risk is that risk, if it happens, if the risk happens, there is a damage to the property and loss happens. And if there is no risk happens, there is no loss at all. No risk, no loss. If loss risk happens, loss happens. This is called a pure risk. Suppose, for example, if I take a car insurance policy on accident, if an accident does not happen, no damage is happening to the car, no risk arises at all. It is a pure risk. In pure risk, if the risk happens, only the loss happens, and if the risk does not happen, loss does not happen. This is what we call as pure risk. Hedging is a uninsurable risk. Pure risks are always calculated in terms of finance, and only pure risks are compensated in the insurance contract. Whereas in hedging, not only pure risks are covered, but also speculative risks are also covered under the hedging contract. The thing which insurance company cannot cover under the risk agreement, insurance contract, such risks are covered under a hedging contract, because no insurance company will promise to compensate for the price fluctuations in the market. It is only covered under the hedging contract. If any price fluctuations are covered under the insurance contract, it is not called as insurance contract, it is called as a hedging contract only. In case of export and import businesses, hedging contracts are made on the price fluctuations of the dollar price. If the dollar price fluctuates, the importers and exporters face the problem in payments of the money. Suppose, for example, India is exporting goods for rupees for $10, where that each dollar price is, suppose if the dollar price is reducing, the buyers, the sellers will receive the less money. So this is all the complications relating to such things are covered under the hedging contract. Next one is insurance is for all financial loss coverage during out of yes, to repeat it again, insurance is for all financial loss coverage arising out of a specified risks, but hedging for stock options or future contracts of commodities or instruments. The third one is insurance is for helping the firms or individual to cover the risk losses, but hedging is a speculative business. In this case, one can easily understand that insurance contract is entered into to compensate for the loss of the insured, whereas it is not giving any specific benefit to the insured. Insured cannot make a profit out of the loss, and insurance company is also doing this business not with an intention to earn a huge amount of profits, but to create a fund to compensate for the loss of the members of that particular group who are exposed to a specific risk. But hedging is a speculative business where one party uh, gains a profit or other party loses a incurs a loss. So hedging is a speculative in nature. Suppose, for example, the seller of a product uh, uh, anticipates that the price of the product may reduce in future and he wants to enter into a contract, sorry, may increase, reduce in the future and he wants to enter into contract. Suppose, for example, the 100 rupee onion price is going to become 20 rupees. He has a speculation that the loss may happen to him. On the other hand, the person who compensates for that particular loss undertakes a hedging contract. He is under the speculation that the price of the onion will not fall down, or even if it and in days to come the market will increase. If he anticipates that, he will enter into a business. So both are looking at their benefits. Whereas in insurance contract, it is a pure contract of compensating the loss of the insured, where the intention is not only to earn the profit. The fourth important point is insurance contract is a common contract, whereas hedging contract is a complex type of a contract. Complex type of a contract in the sense there are a lot of technicalities involved in calculating and anticipating the risks involved in the hedging contract. For example, there are two kinds of a contracts which normally happen. There is a future contract, futures and options. In options, there is again a put option and there is a what you call as a call option. So put option, there are buyers and sellers for it. Call options, there are buyers and sellers for it. So understanding that particular funda and the calculations and entering the contract into that particular is a very complex and pertaining to a specifically market prices of either the share markets or the commodity market. Whereas insurance contract is not like a market price, it is anticipating a specific hazards and risks, and out of those hazards, risks and perils, if the loss arises, those losses will be compensated under the insurance contract. So insurance contract is a very clear and common kind of a contract where anybody who wants to take the benefit of the insurance to compensate for his losses can enter into a contract. And the last important point is insurance contract is considered to be a social service. It involves distribution of a risk among the members of a contract, that is by pooling, whereas a hedging is like a wager type of a contract. Hedging is resembling like a wager type of a contract. So it is like a gambling kind of a business, whereas insurance is a pure helping kind of a business. So on these grounds, insurance and hedging can be differentiated. So the next point of discussion is the types of insurance. So the insurance is having a various classifications of its own. So there are different types of insurance contracts that may emerge. So the insurance industry in India is classified basically into two different categories. One is called life insurance business, and another one is non-life insurance or general insurance. What is a life insurance contract? Life insurance business, or what is a life insurance contracts? So life insurance contract is a contract on the lives of the people. It's a contract where the insurance company compensate the loss happening to an individual out of the death. If a insured person dies, dependents will be under trouble, and those accumulated funds will be given to the dependents. So this is a life insurance contract. Life insurance is also called as life assurance because the terminology of most of the contract terms are referring that the compensation will be made to the insured if he dies or if the agreed period of term expires, that is the contract period expires. After the contract period expires, the accumulated fund will be given to the insured, or if the insured person dies before the expiry of the contract, and dependents will be provided the funds for the security of their life. This is what we call as life assurance contract. Life assurance contract. So here, insurance company definitely compensate the insured out of the premium collected either after the expiry of the time of the insurance contract or the death of the at the time of the death of the insured, whichever happens early, whichever happens first. But non-insurance contract business are called as insurance contract. Basically, if the loss happens only the collected premium will be compensated to the insured. If the loss does not happen, if the loss does not happen, then there is no question of compensation at all. So it is a pure risk. If loss happens, compensation is made. If no loss happens, nothing will be given to the insured person. This is what we call as non-life insurance. This non-life insurance is also called as general insurance. There are basically the four categories of general insurance contract. The first category talks about motor insurance. There is a separate motor insurance contract act which talks about the motor insurance where the accident for the motors, road accidents or theft of the vehicle, fire of the engines to the vehicles. So these three contracts are covered. There is a separate topic to discuss in fifth model 5. We will be discussing on this motor vehicle insurance and types of insurance. We have another called as fire insurance. Normally for the factories or for the buildings, any fire gets into, the compensation will be made for the fire insurance. There is one more insurance called as health insurance. Health insurance talks about the health hazards to an individual. Health hazard to an individual. It is also called as insurance, not a life assurance like, because if the person undergoes any treatment or diseases, then only compensation will be made to him. If there is no any kind of health hazards happening during the contract of period, then no insurance compensation will be made to the person. That's a health insurance contract. So it is a general insurance kind of a thing. And we have one more category called as marine insurance, which is the oldest concept of general insurance. Marine insurance talks about the trading through sea, that is ocean trading contracts losses will be compensated under marine insurance contract. So marine insurance includes the ship insurance businesses, voyage insurance, where if in any particular voyage, if the ship sinks into, the cargo insurance will be there. If the goods are stored in the ship, if the goods get damaged, cargo insurance is provided. So like that, there are different types of insurance under marine insurance. We'll study it separately under the separate model. So friends, I thank you for your patience listening to this discussion. Now I will end the part 2 session lecture of unit 3, that is introduction to insurance. In part 3, we will discuss about the remaining parts of the insurance basics. Thank you. Thank you.